Can you talk a little bit more about how investor sentiment impacts future returns?
Sure. So the evidence now we can say is that a positive market reaction, if you deliver, is great. And you'll do even better as you confirm those forecasts. Think of investor reactions as forecasts. So that's where market sentiment is really important. You're on announcement day, investors are going to make a forecast of whether this is a good thing or bad thing for your shareholder. And so think of the after effects of that. If you're an employee and you have your pension assets invested in your company's stock and it drops by 10%, that impacts employees. Employees and shareholders have a lot in common around that. So it's one of the dirty little secrets of negative market reactions. It really sets a tone that people are living with, like, okay, well, our investors don't believe you. And now we might be saddled with synergy targets that are just nonsensical, because that's what happens. Imagine you start your sign to close planning. One of the things you do in a workshop, your kickoff workshops, is you're assigning synergy targets to the work streams that sit under an integration management office, which we could talk more about. If you've overpaid for a deal, those targets are going to be nonsensical. And if you get a negative market reaction, it's sending a signal that we're off on the wrong foot. We're down 7-0 in the first inning. So it definitely, and customers the same way, which gets back to the point you said about trust, or asked about trust early on. Investor sentiment, it's not just that your stock price went down, it's affecting perceptions from a lot of people.